US stocks hit new highs and the Aussie and Kiwi dollars jump as traders celebrate a US trade deal with Japan with lower tariffs than feared. And Singapore's inflation is low before a monetary policy decision. That's coming up in 5 Things in 5 Minutes on Thursday, July the 24th. And then in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hines looks at why a 50% tariff on US copper imports won't help rebuild its domestic industry.
It doesn't look like much of a chance that these levies are going to incentivise more domestic production. It will just take a multitude of years, maybe decades, before we could see any action on this front.
But first, in 5 and 5 with ANZ, US and European stocks and more risk-sensitive currencies have bounced overnight after news of Japan's trade deal with the United States. Japan secured a 15% tariff on exports to the US versus a 25% rate initially proposed. There's also signs a better European deal with the same 15% rate is imminent, not the 30% Trump had threatened. ANZ head of G3 Economics Brian Martin says markets are welcoming the certainty, but it doesn't change the hit to global economic growth. He still sees the Fed cutting in September.
I think that reflects the fact that, yes, worst case concerns about tariffs in the US are probably dissipating to some degree at the moment. But nonetheless, tariffs are going up. And that is a hurdle for consumers, particularly middle-income consumers and those who are sensitive to price rises. Going forward, I think it is consistent with our view of growth slowing down.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.7%, new record high, and the Euro Stoxx 50 closed up 1%. The US 10-year Treasury yield rose 4 basis points to 4.38%. Gold was down 1.2% to $3,402 an ounce, while West Texas oil futures fell 0.1% to $65.21 US a barrel. The US dollar index was down 0.2%. The Aussie dollar up 0.7% at 65.90 US cents, and the Kiwi up 0.8% at 60.42 US cents. Number 2. ANZ Senior International Economist Tom Kenny says the lower than expected tariff rate will be a positive for Japanese exporters.
Importantly, and this was a major sticking point for the negotiations, was around motor vehicle and motor vehicle parts. They will only be tariffed at a rate of 15%. That is significantly lower than the 25% sectoral product tariff rate that President Trump has set on motor vehicles. So every other country that's exporting motor vehicles into the US will face 25%, whereas Japan will face 15%. The only exception is the UK, which has a 10%, but there's a quota on that. After you've reached that quota, it goes to 25%. So Japan has done very well relative to other countries on the auto front.
Number 3. Part of the deal requires Japan to open access to US exporters in areas such as agriculture and cars. Tom says a third key plank is a requirement for Japan to invest $550 billion US into the United States.
At present, foreign direct investment from Japan into the US amounts to around just about $18 billion US a quarter. So at that run rate, it would take 7.5 years for the $550 billion to be sort of met. Look, there's no details around the timing of this or what exactly President Trump wants this to be invested in. Expediting the pace of the investment into the US economy from the current pace of $18 billion would actually result in the US current account deficit widening, all else being equal, which is contrary to what the Trump administration wants to do. But Trump said with this one, the investment will be at his direction, and he says he wants to keep 90% of the profits in the US. So really, it remains to be seen what's going to happen with that one.
Number 4. The deal now brings into question the future of Japan's Prime Minister after his ruling party lost its majority in the upper house to go with its current minority in the lower house.
We saw that Ishiba said he would not step down and that he wanted to reach a trade agreement. Well, the trade agreement appears to have been reached, and now I think there will be speculation about his leadership going forward. Look, I think regardless of whoever is leader, if it's Ishiba or someone else, I think they're going to have to turn a little bit more dovish on both fiscal policy and monetary policy. The opposition parties ran on looser fiscal policy. In particular, they wanted to lower consumption tax rates.
Number 5. In other news, Singapore's annual inflation rate stayed at 0.8% in June, slightly below market expectations. Core inflation stayed at 0.6%. ANZ head of Asia Research, Koon Goh, says the results don't change what he expects the Monetary Authority of Singapore, or the MAS, will do with monetary policy.
We have the MAS July MPS next week on Wednesday, the 30th of July. We are not expecting them to change policy at this stage. So despite there still being risk to the downside to growth due to uncertainty around tariffs. The fact that the Singapore economy has actually performed much stronger than expected in Q2 so far is providing room for the MAS to just be patient and wait out the decision next week and have a better assessment once we know the lay of the land in regards to US tariffs post 1st of August.
Couldn't go there. Now, in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hines looks at the implications for the US copper market and its suppliers from Donald Trump's 50% import tariff on the metal.
It's the world's second largest producer, a fair way behind China, who is number one, but still consumes around 2 million tonnes per year of copper in various forms. It only produces a small fraction of that. In fact, refined output sitting at around the 800,000 tonne mark. And they do produce a bit of scrap or copper from scrap as well. So overall, their import reliance is essentially sitting around 40% at the moment. Now, they only have 3 copper smelters in the country. And, at the moment with the concentrate market, so the copper ore that is processed in smelters being relatively tight, margins for copper smelters are extremely low. In fact, in China, where the biggest amount of capacity is held for smelting and refining, we're actually seeing negative margins at the moment. So this is due to those smelters fighting for any available ore there is on the market to process and keep their operations running. So the economic incentive to build more smelters in the US would be relatively low if you're facing negative margins. That's amidst, I suppose, this ongoing sort of difficulty around the development and construction of smelters in Western countries, as I suppose the environmental issues become greater and greater now. So, it's all stacked up against the US really building any sort of meaningful processing capacity or additional processing capacity that could potentially allow them to meet, those domestic requirements. And so I think certainly from our perspective, there doesn't look like much of a chance that these levies are, going to incentivize more domestic production. It will just take a multitude of years, maybe decades, before we could see any action on this front.
Is it possible America could use more of its scrap metal? Because it seems a lot of that's going overseas at the moment.
Yeah, well, in fact, they are the world's biggest exporter of copper scrap and primarily send it to China, who are the biggest consumer of copper scrap as well. And in fact, if we did see every copper unit that comes from scrap stay within the US, then there is a potential that they could certainly meet their domestic needs. But once again, that would require processing capacity, so recycling plants. We have seen a couple actually just start or about to in recent months, but they only cover a minuscule amount. We're talking less than sort of 10% of copper in scrap contained. So we would need to see another 10 of those similar sort of facilities to really fill that gap that we're calculating at the moment. And this has been an issue I think the industry has talked about. There were some calls for export duties or tariffs on copper scrap from the industry to try and obviously keep that copper within the borders. But Trump has gone down his tariff route, instead applied or used that lever on imports themselves. So we'll have to see how that plays out. But even that case, it does look like it would take some time for that to eventuate.
And who are the potential losers here, aside from the US consumer who may have to pay more? What about the major exporters of refined copper into the United States?
Yeah, well, they would certainly be seriously considering where they send their copper at the moment. Countries like Chile and certainly Canada and Mexico who are caught up in some of the tariff sort of wars that Trump initially launched. So we could see some complications around that as well. They'll certainly look at other export markets. Certainly China, being the world's biggest consumer, is clearly one of those. But I think more broadly, regions like Europe will be something they would look at. But, those countries would certainly be considering, I suppose, all of their options at the moment, seeing that, their product is going to cost significantly more when sent into the US.
Daniel Hines there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, July the 24th. Catch you tomorrow with a look at how US manufacturing is performing. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.